Now, let's look at some quantitative trading strategies. There are always a few technical indicators that you should follow. Of course, it is not like the stock market. In the stock market, there is an underlying asset for your stocks which has some kind of dividends, which might have a factory, which might have a real world asset class behind it, behind the company. So it is not like a stock market. But some of the quantitative factors used in the stock market can also be used in the crypto market, but for an additional due diligence point of view. For example, the Relative Strength Index, the RSI. Now, we all know what RSI is. It is a value which shows whether a particular stock has been overbought or oversold. If it is overbought, the graph might slow down. If it is oversold, the graph might become faster. So the index is basically out of 100. So it is between 30 to 70 that you would need to look at. If it is too hot or too cold, don't get into it. So look at the Relative Strength Index and take a call. Take a decision on your own. A good another quantitative factor is the simple moving average. For example, the SME 20. The simple moving averages depend on the timelines. So in this, SME 20 is average for the last 20 days. It can also be SME 40, SME 60, etc. Depending on the SME 20, you can maybe draw a trend line. You can see a trend whether the particular graph is going up or the graph is going down. And similarly, you can take a decision for traders. For active traders who perform trading on a day-to-day basis, sometimes the SMA might not work. So they do use something called the exponential moving average. Here, the weights are assigned for the recent days and a lower weightage is given to the older days. So the exponential moving average is also a good quantitative factor to check out if a particular crypto is going up or down. For day traders, when they perform scalping, that is, you get in and you get out of multiple times during the day and you try to skim off a profit, there's also a range-based trading. There is a high frequency day trading that the folks can perform. There's also swing trading that folks can invest in. But the best part is the position-based trading, where you get into such as a limit order or a stop loss order to ensure that you don't lose a lot of amount of money. So you get in and then you put a limit order saying that if it goes below that or if it goes above that, you either withdraw, making a profit, or you deposit more to make more profit. If the crypto is falling down, you have a stop loss order and you will get out before you lose much more money. These days, a lot of people are using something called bot trading, where folks have created algorithms to actually trade depending on the performance of the crypto. It could be based on arbitrage across various jurisdictions. It could be based on social cues depending on the number of mentions of a particular cryptocurrency across social media. For example, if everybody is talking about Bitcoin in say Facebook, the bot can perform this social media analysis through open source intelligence, through collecting OSINT data, and then perform their own bot-based trading. There are more trading strategies which a bot can perform, such as advanced trading or decentralized finance space-based trading, where folks can create algorithms to make a nice profit in these specialized industries. Almost 80% of today's trading is performed by a bot, which is why folks such as you and I who actually get into day trading, sometimes they may make money, but many times they do lose money. People also need to look at the price action by reading the patterns on charts. There are various kinds of charts. You can hear multiple types of charts by just doing a Google search, and by reading the price action, you'll be able to create your own methodology to perform quantitative factor-based analysis. So these are a few trading strategies that you can pick up from the stock market and can be used for cryptocurrencies. I haven't gone too detailed into that because cryptocurrencies are not the same as stock markets. For example, on Ethereum, if everybody is using Ethereum and the underlying crypto Ether, the value of Ether will increase. When the value of Ether increases, that means using the Ethereum blockchain will become much more costlier. You cannot perform decentralized applications on that. You cannot perform DeFi activities because the Ether itself has become more costlier. So what happens is folks will migrate from Ether to other blockchains such as Solana or any other blockchain. That means the rise in value of Ether will ensure that the price of Ether itself will go down in the future. This does not happen in the stock market. In the cryptocurrency market, what happens is your stock directly affects your blockchain's performance. So the quantitative factors might not work in the case of crypto. And you should be aware of these kind of technicalities in the future. What happens is in programmable blockchains, the underlying asset needs to be extremely cheap for the blockchain to perform much better. But in cryptocurrencies such as Bitcoin, Dogecoin, etc., the costlier the value of the currency itself becomes, the more value it gets. So more and more quantitative factors are used to try to understand. For example, you should find out the entire circulating supply of a particular cryptocurrency. So how many cryptocurrencies are there right now in the supply? What is the total supply as on today? What is the maximum supply that can go? For example, to take Bitcoin's perspective, Bitcoin's maximum supply is 21 million. There will be only 21 million Bitcoins ever in the future. But as on today, the total supply is around 18.5 or 19 million. This is total supply. The circulating supply will be much less than this 19 million because 3 million Bitcoin are lost forever, so we cannot take it back. There might be large whales or exchanges who have collected this Bitcoin and they're not trading, and they can be used up by various kinds of different organizations. The circulation supply is usually much lesser than the total supply, which is much lesser than the maximum supply. So again, to reiterate, Bitcoin's maximum supply is 21 million. The total supply is around 18.5 million, but the circulating supply might be around 10 million. The next important factor that to keep in mind is the market capitalization. Now, what is market capitalization? It is the number of cryptocurrency that exists today multiplied by the current price of that cryptocurrency. That is market capitalization. What is current market capitalization? What is the current fully diluted market capitalization? That is, for the maximum supply, when you multiply by the price, what could be the market cap? So usually the market cap fully diluted is much more than the current market capitalization. How much of volume of Bitcoin is being traded as on today? What is the volume to market cap ratio? How does the distribution look like? For example, how many wallets have how much of percentage of Bitcoin or any other cryptocurrencies? We also need to find out what is the liquidity. Liquidity is that, can I buy Bitcoin tomorrow very easily? Is it liquid? Are people selling the Bitcoin for me to buy? What is the velocity? How fast can people buy Bitcoin? Are there enough trades happening? Is somebody buying that particular cryptocurrency every single day, or is it just once in a week kind of phenomenon? What is this velocity? You also need to understand the holders' statistics. That is, how many people are holding, how many people are selling, how many people are not interested in selling, what are the price hikes, what are the price lows. So there are a lot of quantitative factors that you can look at before you invest your actual money into it. For example, in this graph, just look at Dogecoin's distribution. We have almost 67% of all Dogecoin availability belonging to only 100 wallets. That is, 100 people across the world hold almost 67% of the total number of Dogecoins availability. So this gives you a distribution angle to it. Even if one wallet or two wallets out of these 100 wallets think of dumping these Dogecoins, the entire valuation of this cryptocurrency will fall rapidly. So you need to look at the distribution of the cryptocurrencies as well before getting into this particular domain. So we've spoken about different kinds of qualitative trading strategies, quantitative trading strategies from the stock market that you can use. But more importantly, you need to understand the theory behind that cryptocurrency, whether you think that that particular theory will solve that particular cryptocurrency's use case, and what is the distribution, what is the velocity, the liquidity, the market cap. You need to look at all these factors before you invest real money into this space.